You have a mortgage, a car loan, credit card debt, student loans, and every month you pay and pay and pay. But here's what they never tell you. You're not expected to pay it off. You're expected to stay in it because your debt isn't a burden to the system. Your debt is the system. And it was designed this way 300 years ago, where money, power, and history collide, and nothing is ever as simple as it looks. Most people see debt as a failure, a personal mistake, proof of a lack of discipline. But here's the truth. Debt isn't a mistake. Debt is the foundation of the modern economy, and you being debt-free is the system's greatest fear. Because if everyone paid off their debts tomorrow, the global economy would begin to collapse within hours, banks would close, the money supply would dry up, and the system could not survive. So how did this happen? Who designed it? And how can you escape this trap? Chapter 1. The Birth of the Debt System. The story begins in 1694 in London. King William III of England is nearly bankrupt from wars. He's fighting France. His armies need to be fed. Weapons need to be bought. But his treasury is empty. If he raises taxes, there's a risk of rebellion. If he forcibly takes money from the people, he might not stay on the throne. So what will he do? A group of wealthy merchants and bankers presents the king with an offer, simple but brilliant. We will give you money, as much as you want. But in exchange, you will give us something, interest. And to pay that interest, you will collect taxes from your people. And to manage this arrangement, a new institution is created, the Bank of England, the world's first modern central bank. But there's a hidden trick here, because these bankers aren't just giving the king their own gold, they are creating debt on paper. They're giving the king notes. The king spends these notes, and in return, he guarantees to pay them a portion of the crown's revenues. The result, debt becomes an asset, a tradable commodity, something that can be bought and sold, and the king never fully pays off this debt. Because the system isn't built on that. The system is built on perpetually renewed debt. Every year, new bonds are issued. Every year, more debt is created. And every year, the English people pay taxes to cover the interest on this debt. This model made England an empire, because by borrowing, the kingdom could wage unlimited war and expansion, even if it didn't have real money. And then this model spread across the world. France copied it. The Netherlands copied it. The newly founded United States used exactly the same method to finance its war of independence. Debt was no longer a shame. Debt meant power. Chapter 2. Individual debt. The system's expansion. But for centuries, this system only applied to states. Ordinary people rarely borrowed, because banks wouldn't lend to farmers or workers. The risk was too high, and there was no guarantee of repayment. But in the 20th century, everything changed. After World War I, economies began to grow. Companies increased production. But there was a problem. The public didn't have the money to buy all these manufactured goods. The solution was simple. Lend to consumers, give them purchasing power now, then have them pay it back over years. In the 1920s in America, the installment payment system exploded. People could now borrow for homes, cars, furniture, even clothing. And this revitalized the economy. People spent, companies grew, banks got rich, and it was exactly what was wanted. But in 1929, the system collapsed because too many people had taken on debts they couldn't repay. The stock market crashed. Banks failed, and the Great Depression began. But the system didn't disappear. It was simply reorganized and presented to people again. After World War II, governments added more controls, mortgage guarantees, federal insurance, regulated credit systems. And then, in the 1950s and 60s, something new was born: the credit card. At first, it seemed like just a convenience. You could shop without having to carry cash. But banks soon realized something. If people didn't pay their balances in full, they could charge interest. and that interest meant massive profit. By the 1970s, credit cards were everywhere, and banks began using psychological tricks designed to keep people in debt, the minimum payment option. Just pay $25, relax. But here's the reality. If you only make the minimum payment, you'll be paying off that debt for decades, and you'll pay more in interest than the original debt. The system was designed to keep people in debt, because a person in debt is a person who keeps working, a person who can't afford to lose their job, a person who doesn't rebel, doesn't protest, doesn't challenge the system. Today, the average American owes $145,000. Mortgage, car loan, credit card, student loans. When it all adds up, people spend their lives paying off debt. And it's not just individuals. Corporations are in debt. Municipalities are in debt. States are in debt. Countries are in debt. Everyone owes someone. So who's the creditor? Chapter 3. National debt. Debt that will never be repaid. This number is so large it doesn't even make sense. No person, no government can pay this debt. And they're not trying to anyway. Because modern governments don't borrow to pay off debt. They borrow to renew it. Every year, the U.S. Treasury sells bonds. Who buys these bonds? Banks, pension funds, foreign governments, and most importantly, the Federal Reserve. The Federal Reserve is America's central bank. And it has a trick. It prints money digitally. Then it uses that money to buy the government's bonds. This means money is created out of nothing. The government borrows. The central bank buys that debt, and in return, new money enters the system. This process is called quantitative easing. And it's actually an indirect tax, because the more new money is printed, the less the old money is worth. Inflation. Your salary stays the same, but your purchasing power erodes every year. The price of bread goes up. The price of gas goes up. The price of housing goes up, but your money doesn't. So even if the government doesn't openly tax you, it's stealing from you through inflation, and the system depends on this. If the U.S. tried to pay off all its debt tomorrow, what would happen? The bond market would collapse. Because bonds are considered the safest asset in the world. Pension funds, banks, insurance companies, they all hold bonds. If bonds disappear, these institutions have no safe asset left. The money supply would contract. Because no new debt is being created, which means no new money is being created. Deflation would begin. The economy would shrink. Unemployment would explode. And the result, even if the debt is paid off, the system collapses. So the debt will never be repaid because the system depends on it not being repaid. And this isn't just in America. Japan is playing the same game. Europe is playing the same game. Even China is playing the same game. The entire world lives in an economy built on debt. And this debt must keep growing because the moment it stops, the system collapses. Chapter 4. How do you protect yourself? So what does this mean for you? Because this isn't just macroeconomics. This is the story of your paycheck, your savings, your future. The first step is to see the game. Debt isn't a failure, but it's also not a tool. Debt is a control mechanism. Governments are in the hands of banks and investors because they're perpetually in debt to them, and you're in the hands of banks because you're perpetually in debt to them. So how do you protect yourself? First rule: avoid unnecessary debt. Consumer loans, credit card debt, these enslave you. If you can't buy something outright, you don't really need it. Second rule: acquire real assets. Debt is a digital promise, but land, gold, skills, means of production, these are real. Even if the system collapses, these remain. Third rule: be aware of inflation. Every year, your money loses value. Accept this. And don't be the one holding cash. Be the one converting it into assets. Fourth rule: learn to live debt-free. The system is designed to keep you in debt. Living debt-free means liberating yourself from the system. And the final rule: arm yourself with knowledge. Most people don't understand this system, but when you do, you make different decisions. History shows us that debt destroyed empires, bankrupted corporations, tore apart families. But history also shows this: people who understood the system survived every crisis. Debt is a trap, but if you see the trap, you won't fall into it. Conclusion: the modern world is built on debt. Governments are in debt, corporations are in debt, individuals are in debt, and the creditors, they're in debt too. Because the system is circular. Everyone owes everyone. But this cycle can't last forever. History has shown us this again and again. When debt explodes, and it will, the ones left standing will be those holding real assets, not paper promises, real value. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.